nothing we do is proprietary. What we have might be. If you were to Google best practices of raising capital, aside from attending events, getting warm leads, and kind of the normal stuff you would imagine, it is consistent outreach with consistent follow-up. Investors have a job. Their job title is an investor. Could be partner, associate, analyst, whatever the case may be, but nonetheless, their job, their industry is investment. And what that means is that in order to make money for these people, they must invest money into companies they believe that are going to give them back more money than they gave it. A lot of founders will overcomplicate, write a 52-page business plan to go out and try to raise capital, and it's really unnecessary at an early stage, in my opinion. I believe that fundamentally you need a deck, a model, a valuation, and a capital structure in order to go out and at the very least begin your capital raise. When you are selling to your customers, what is important are the features of your widget or your product or your service.
And welcome back. Hello, everyone. And today I'm very excited to have Jeff with me. He's the co-founder of Fidelman and Company. Today we're going to talk about important part of health tech startups, and every entrepreneur must listen to this episode because we're going to talk about the blood of any business, which is capital and money and fundraising. Jeff, welcome to the show.
Thank you, Ruben. Thank you so much for having me.
Thank you so much for being here today. And I really want to grab your mind about like lessons and things that healthcare entrepreneur who's raising money can learn from you, especially like you've been this for a while and you work with many founders. But before going through those like pearls, I want to hear more about you and your background. What really inspired you to focus like on fundraising and investment banking for specifically like early stage startups?
Not by design. I'll start
Not by
with
design. Tell me
not
what.
by
Tell me
design.
what was the design and how you are different.
Sure. So I graduated from Harvard and I went down the traditional finance track.
Okay.
I spent the better
Did you
part
do
of a
an MBA
decade.
there?
No, undergrad.
Undergrad. Okay.
Yep. And I spent the better part of a decade in banking between Morgan Stanley
Yeah.
and HSBC. And while I was there, I was recruited by a family office who had wanted to start a venture fund, where I became a partner. And the focus there was investing in early stage tech and tech-enabled companies. And that was really my first exposure in a formal capacity to originating, doing diligence, underwriting, allocating to, and operating with early stage entrepreneurs. And when the first fund we deployed, it was a little over $100 million across 45, 47 companies. In 2015, I recognized that banking and venture banking, venture banking does not exist. And it's very much by design. And I sat and at the time, I had plenty of time to think about these types of things. And I was thinking about how there is a misalignment of interests where if you try to apply traditional investment banking to venture banking, the interest there being the investor always wants to hear from the founder or from the company or have a relationship, especially at an earlier stage, with the company that they're investing in.
Yeah.
And from the other side, and this is, I often walk into conversations with a black eye for a fight I was not in, of these advisors who are promising the world, are promising that they have 32 investors in their phone book and Rolodex, and that's who's going to invest in the company.
Yeah.
When you are able
for the
to,
founders.
for the founders, right? And when you're able to really sit and think about, well, what is the interest and what is the alignment there? That company A comes to the broker goes to John Smith, the investor. Company B, John Smith, the investor. Company C, John Smith, the investor. And all of a sudden, you have this relationship where the company is paying the advisor or the broker for a relationship that the broker has with the investor, which is more important to him or her than the company that's paying him. And that is purely in and of itself a misalignment of interest of at least on the venture side and early stage companies of how it works.
100%.
When we set out to do and put together this company, we knew that there's a big gap in early stage companies in either first time or quite frankly, serial entrepreneurs that just don't have the bandwidth or skills to put together their fundraising presentation and narrative, let alone executing on a fundraise.
Yeah, correct.
This isn't to say that they're incapable of doing something like that, but to ask a founder to sit and spend a week plus or minus, depending on how much bandwidth they have, putting together a deck, a model, doing all the work and actually putting those things together, the copywriting, the narrative, design, the financial modeling and formulation, the valuation
Business plan
analysis,
and the
all those
cap
bits and
table.
pieces. First of all, it's unlikely to be their expertise.
Mm-hmm.
And second of all, there is a reason why people say fundraising is a full-time job.
Correct.
So it was almost a perfect storm back in 2015 with my having had experience in banking, experience in venture capital investment as a partner at a fund, that I was able to go out and really structure at first what was a consulting firm that has now grown into an investment bank with over 40 people, entirely remote, where we can say that we engage with roughly 100 companies every year to help them either put together all of their fundraising materials or actually go out and help them raise the capital themselves. One of the biggest difficulties in
Mm-hmm.
putting together that last part, which is helping them raise capital, is what we now are calling fundraise as a service. And simply put, or anecdotally speaking, the last deliverable that we would provide our clients was a fundraising strategy, was pretty much a book
Yeah.
we would pull from PitchBook or Preqin or Fintrix or whatever we had access to at the time. Copy that we would write for them to do outbound email, copy we'd write for them for calling, giving them essentially a structure of this is a customized
A
strategy
blueprint.
how to go raise capital. And funny enough, what happened was 12, 16 weeks later, almost every single one of those entrepreneurs that we'd work with would come back with that same book and say, Jeff, this is great. Can you do it for us?
Mm-hmm.
And
What
that's
do
how
they
we
mean by
ultimately,
can you do it for us?
meaning doing all the outreach, doing the top of
So they
funnel
want you to do the
generation of
outreach and reach out to the
investors.
sources of the capital.
Exactly. So taking that want, need, and I don't know, opportunity or demand, but also coupling it with what I had said earlier around not being a broker reaching out to investors, because I knew that when I was a venture investor, it would be the first and last time I hear about a deal.
Yeah.
So what we structured Fundraise as a service, it has become more as an outsourced investment relations team, where our company has the database of all the different platforms that we subscribe to, PitchBook, Fintrix, Preqin, and a number of others. We have an analyst who does all the copywriting, who does all the calling. This is what he does all day long. And our companies basically rent that infrastructure from us on a month-to-month basis so they can drop it in. Alex, the analyst, calls from ABC Company, or Alex, the analyst, is emailing from abc.com, so that from the investor's perspective, it's the company that reaches out to them directly.
So it's Fidelman and company reach out to the investor. Is that right?
It's ABC Company that reaches out.
ABC company. So
So if
ABC company,
Widget,
like the ABC company
Widget,
is a startup.
right, ABC Company being our client, whoever hires us.
Gotcha. They come and hire you and tell you like we're gonna raise money.
Right. Well, they say we're going to raise money, then they hire us.
Yes.
Um,
What
and
happens
the
next?
idea is that right. So the whole premise of what we do, and I always kind of say tongue in cheek that nothing we do is proprietary. What we
Mm-hmm.
have might be.
Mm-hmm.
Meaning, if you were to Google best practices of raising capital, aside from attending events, getting warm leads, and kind of the normal stuff you would imagine, it is consistent outreach with consistent follow-up. And that's where a lot of entrepreneurs, founders, co-founders, fund managers end up failing, not by design, not because of a lack of effort, but it's a truly becomes a consistent factor of continuously reaching out, first generating the investors and top of funnel, and then
Mm-hmm.
continuously reaching out to them through a systematized process of actually getting them to the door or getting them to have a conversation with you.
Gotcha.
And it becomes more difficult because even with fundraising,
Mm-hmm.
you can't do this on a blast basis. And to have a juxtaposition with a lot of the listeners here who might have products or widgets or services that they are promoting, with a product or service, when you are selling it, it is important to first define your market and then go as broad as possible within that definition. With raising capital, it's a similar approach, but you have to consistently refine and define what your target or who your target audience is of investors, but also individually personalize all of your outreach to them. So it
Mm-hmm.
can't just be, hey, Mary Sue, you're a healthcare investor or health tech investor. I'm a health tech company. We should get together. But there needs to be more of a conviction around the thesis or the investment philosophy or other companies in their portfolio so that you can create a meaningful connection immediately, since this is cold.
Gotcha. So while we're talking about that point, I want to expand more since like you see lots of founders are raising money and they're raising capital, and you mentioned like how they should reach out to investors and personalize things. But like, tell me like, what are the most like five common mistakes like you see that founders, whether like first time founders or second time founders or serial entrepreneurs like do on a regular basis when they're raising money?
Only five you want?
I don't know. Tell me as much as you want.
Well, I'd given a presentation earlier today for an accelerator on the same topic.
Yeah.
I think the first comes to mind, and this is in no particular order, but the first mistake that comes to mind is not asking for money.
Tell
And
me
I'll
what you
say
mean
that
not
again, or I'll
asking.
say it other in the contrasting way. Make sure you ask for money, especially if when and if on a call with an investor. And I say that because, I always think back to the anecdote where one of our well, now I tell everybody to ask for money, but before I did, and the reason I do that
Yeah.
is that we had a client who we were having a debrief call after their first investor call. We're not on those calls. It's just between founder and investor. And somewhere in our debrief, I asked him whether or not he asked for money. Interestingly enough, this was a also a healthcare company. Um,
Hmm.
and the moment I asked him this question, he threw his hands up in the air. He got red in the face, yelling at me, asking me why I never told him to ask for money. This is
So he
after he
he
had an
talked about
investment.
his pitch, but he did not ask for money.
And I see the surprised look on your face, and it is often the case when I tell this story, people are surprised. But you would actually be surprised how rarely founders ask for money on their pitch calls. Actually, statement, not just going through the pitch, but we are raising $5 million. We want you to invest $1 million. What is your average check size? What is your next step to make an investment decision in our company? Any one of those things are a step forward in the sales process and the capital raise process. And it's surprising that many founders don't actually do that. So
Yeah, I
I'll
can remember now some people message me on LinkedIn and talking with me through their pitch deck, but without asking for money. Probably they were asking for money. I just didn't know it.
and it wasn't explicit, right? Like the point of
Yeah,
a
like
call with them or the point of a call when you have with an investor
hmm.
is it's a money conversation, right?
Yeah,
And
exactly.
even taking a step back for everyone that is raising capital or considering raising capital and knows about the environment that we're in right now, just remember investors have a job. Their job title is an investor, could be partner or associate analyst, whatever the case may be. But nonetheless, their job, their industry is investment. And what that means is that in order to make money for these people, they must invest money into companies they believe that are going to give them back more money than they gave it.
Exactly.
Again, I know this is seemingly super obvious, but
Yeah,
the point I'm making, and the reason I'm saying that is that just keep in mind the person that you're sitting across from has an incentive to actually invest in your company, despite them saying no as many times as they're seen saying no.
hmm.
So that's kind of number one is ask for money. Number two, and again, these are not in any particular order, is keep it simple. A lot of founders will overcomplicate, write a 52-page business plan to go out and try to raise capital, and it's really unnecessary at an early stage, in my opinion.
Yeah.
I believe that fundamentally you need a deck, a model, a valuation, and a capital structure, and those
Hmm.
last two can be combined in order to go out and at the very least begin your capital raise.
Hmm.
Will you have requests for additional documentation, diligence, or otherwise?
For
Possibly,
sure. There are
not
tons of
probably.
documents.
But there's nothing that you need to over prepare prior to going. I mean, you should be prepared with knowing what's in your model, what's in your deck, and really focus in on those pieces. But it's not necessary to over prepare and create a ton of collateral that no one is asking for, at least initially, to meet you. So
Right.
keeping it simple is important.
Hmm.
I think another aspect that a lot of founders, and I'll kind of maybe I'll cap it off on the third one unless something else comes up, but a lot of founders don't recognize is that when you are selling to your customers, what is important are the features of your widget or your product or your service.
Hmm.
So customer is going, and now especially a customer being informed is going to look at whatever you're selling them and say, okay, is this worth what I'm paying?
Hmm.
How am I in my mind either getting a return or substantiating the payment that I'm making for this item, for this service? So I want to know about the features. I want to know about the bells and whistles because that's how I justify the spend as
Hmm.
as a consumer. Now, as an investor, it's a very different psychology. Now, all of a sudden, I don't really care so much about all your bells and whistles and features. I, as an investor, want to understand fundamentally how you are going to make money.
Exactly.
I can understand that. And by the way, this is all in the initial pitch and presentation. If I can walk away from the initial pitch, understanding and believing that you are going to make money and this is how you're going to make money, it makes my decision as an investor that much easier to take it to investment committee, to move it forward in diligence, to gain some sort of conviction behind, I just spoke to Rupin, the founder of ABC company. I know exactly how he's going to make money. I understand the market. I know he's going to grow. Let me get behind him and put my money behind that company. So really making sure that you walk away from the meeting knowing that the investor understands how you make money as a business is incredibly important.
Yeah, I completely agree with you. And as like as simple as it sounds, like right now we're talking about it, but it's not. So I attend on average like 3 to 5 pitches a week
Hmm.
through my deal flow, and not lots of people say how much they are. Actually, none of them say like what is the projected return on my investment and over what time period, because like everyone is competing for the investor money, starting from the treasury bills and how much they pay you versus a stock, how much it pays you versus like a venture capital fund versus a startup itself. So I think a startup itself, a company itself, is the riskiest, and the treasury bills are the least risky. So as you go with this from the least risky to the riskiest, like you should probably have a decent return that beats the stock, that beats the treasury bill over a okay period of time, not to 10, 5 years. And if you have a plan, that makes everyone's life much easier. And I agree with you. Like now I'm going through flashbacks. Like all the founders talk about like their TAM, their SAM, and the problem they are solving, but no one talks about like how much I'm going to return money or what is the expected return over what period of time, and which is the most important thing, to be honest with you.
Right. Well, I will put one caveat on that, or maybe
Yeah,
two,
tell me.
actually. The first is make sure you present it, I don't know, to a toddler, as many people would say, but to someone
Yeah,
with experience or knowledge in the industry first before you go out to investors, so that they can ask you the stupid, ignorant questions, and then you, who's in it every single day, the founder, can figure out a way that, okay, I'm not communicating this to a layman's person. I'm communicating this to someone who already has most of my knowledge.
yeah,
Figuring out a way to keep it simple and just fundamentally show the investor how they're going to make money. Now, to your point in terms of calculations, I don't know that they necessarily, I don't,
it's
early
hard.
stage
It's very
companies, I
hard
wouldn't
to predict how
necessarily
much
like
over what
put a
time.
number, right? So I wouldn't put like a number in the
Yeah,
deck
it's hard to predict the
presentation.
discount rate or the interest rate.
Right, but at the very least, yes, you're absolutely right. There should be a knowledge of, okay, valuation, here's what my valuation is based on these multiples that I used and did an analysis on. And if you believe in the model, we'll put the same exact multiples on the third, on the fourth, on the fifth year, and I can show you how that valuation increases,
Yeah,
assuming all things remain equal, and how your stake or your return increases over time as well. But
yeah,
it should be that clear, not something that is convoluted or buried in like a 20 or 30 or 40 tab model.
yeah. No, I completely agree with you with that. Now talking about it now, it's more like it's coming to me, but it's not something I see in like a startup pitches. Let's talk about equity. It's something that always comes into my mind. And one of the horror stories I heard about like this founder who raised like a who sold his company for $1 billion, but he ended up only keeping 3 million because like he gave up so much equity. So like how much equity you should give on average, like in the pre-seed, seed, A, B, C series, like for someone so that they don't end up being that diluted.
Good question. I'll take one step back or half a step back
Yeah.
and I'll kind of step forward to answer your question. It's really important that everyone gets on the same page in terms of how dilution works so they can really understand percentage, total number of shares, and value of equity are three independent calculations. Yes, of course, they're overlapping. However, they're three different measures of your standing within a company.
Yeah.
What I mean to say that is you own a company, you own 100% of the company, there are 100 shares of the company.
Mm-hmm.
Jeff is the investor. He wants to come in. He wants to buy 10% of your business for $1 million. I give you $1 million. Now, here's kind of the point. You, Rupen, do not give me shares. There are a brand new 11 shares created at the company. So now you keep your 100 shares. That does not go away. I get 11 new shares of the company. And now there are 111 shares in the
11
company,
shares of total. Yeah.
right? I have 11. 11 over 111 is 10%. 100 over 111, 90%. So that's how dilution works. You've kept the same number of shares that you've had.
You issued more shares.
The company issued more shares. You retain the same amount, so your percentage of the whole pie goes down.
Similar to what happens in public companies. They
Right.
issue more
Right,
shares.
right, exactly. And well, public companies, the shares are traded between investors, individuals.
Yeah.
They're not being created new after like the IPO.
Yeah.
Or really, I mean, the IPO is just
The
shareholders sell.
initial offering of those shares. Yeah.
Right. So that's kind of step one, so everybody understands what that looks like. Now to answer your question, on average, the first two stages of the first two rounds, like full proper rounds of a company, typically,
Pre-seed and seed.
uh, well, I would combine pre-seed and seed and Series A into one,
Okay.
despite there being some conjecture and separation between pre-seed and seed. But let's say pre-seed and seed, you're looking at about 20% of the business, maybe 25% of the business that you're giving up.
Mm-hmm.
And then in Series A, it's another 20%.
Mm-hmm.
This is a huge metric of averages. And I really want to provide that disclosure to everyone out there. There's certainly companies that give up more in earlier stages and then less later on. And then other companies, to this billion-dollar company that sold with very little to the founder, probably continued giving up 20% into the third or fourth round, where they ended up with, I mean, I don't know, on $1 billion, $3 million, like less than 0.3%.
I still want to still hover like I still want to focus on the early founder.
Mhm.
Do you have a preference, or which one do you think is? I don't know if you have a preference, or one is friendlier to the founder more than the other. Safe versus convertible. Which one do you think it's better or less complicated?
I, given that we're on a podcast, I'm not a lawyer, not an accountant, so I want to throw that disclosure out
Yeah,
there.
yeah, yeah. So
Um,
people can hear it. Yeah.
my understanding is that the main difference between a safe and a convertible is the interest.
Hmm.
On a convertible carries interest that is payable in equity, whereas a safe does not carry any
Yeah,
interest.
one of them is debt instrument, the other is not.
So for that reason, a safe note is more founder friendly.
Gotcha, gotcha. But you don't have a specific preference.
I
Uh,
mean, unless it
yeah.
is an egregious type of terms or offer, the money is the money. And if you have one investor and you're pushing a safe and he or she is telling you no, but I will invest on a convertible note. Look, devil's in the details, so make sure you cross your T's and dot your I's.
Hmm.
But it's not like I would not. I always to tell our client, unless there is a red flag or a major issue with the offer, as long as you need money and this person's offering you money and the terms are good, that money will allow you to grow. So you need to make a decision. The founder needs to make a decision of how expensive or how willing they are to take on that capital.
Gotcha. I want to shift gears now.
Sure.
Pitch deck. So we talked about like maybe mentioning an idea about the growth and the expected percentage of return on money.
Yep.
What else is important? Like, what are like you said, keep it simple, but like how simple?
So the first 3 pages, not including the cover of a presentation, if your
Yeah.
printer were broken and that's all you could get and you need to show them or use that as reference, those 3 pages should be enough to get you through the first meeting.
Hmm.
What are those pages? It is the problem or opportunity, depending
Okay.
on the business and the industry you're in.
Yeah.
It is the market, it is the solution.
Hmm.
And the way that you position those, now remember, when you're meeting with an investor, do not put a pitch deck up on the screen to share unless explicitly asked. You want to have a conversation with the investor about your business. So what I'll say for the pitch deck remains on how you start your narrative, but please make sure that whoever and everyone listening, that you understand a pitch deck should essentially stand on its own and should be used after an initial conversation with an investor, not beforehand.
Hmm.
So with that being said, each of those 3 initial pages, problem market solution or opportunity market solution,
Hmm.
is meant to convey a single binary idea. And that's what should be the goal. Again, you will hear a recurring theme with me in that, I try to keep it simple, KISS methodology.
Yeah.
And what I mean by that is on the first page, you'll have your problem statement, 3, 4 bullet points that are kind of pain point specific problem issues. but you really want to communicate to the investor that there is a problem, and for that investor to turn the page with the binary agreement that, yes, I agree that there is a problem.
Mm-hmm.
That is and should be the only goal for that first page of ingestion or reading. It should be the investor turning the page saying, yes, there is in fact a problem. I agree that there is a problem. The next page, there's 2 to 3 main components that need to be included. Number one, which goes back to common mistakes I often see, make sure your problem page illustrates quantitatively the problem on the market page, right?
Yeah.
Don't tell me about there being famine in South America and then tell me about, fast food rates in Europe. I mean, I'm making an extreme example here,
Yeah.
but
Yeah.
make
Yeah.
sure that the market sizing page is
Mm-hmm.
relevant to your problem page, that it actually problem, yes, I agree there's a problem, because on the next page, what I want you to show, what I want our clients, what I want our founders to show the investors, that, okay, now that I've agreed there's a problem, I need to first see that this problem is quantified. Number two is that this is a big problem. And equally as important, number three, is that this is a growing problem.
Yeah.
Not just big, because if it's big and shrinking, it is not of interest to investors.
Yeah. Fair enough.
So going now back again to the binary outcome, page one, yes, there is a problem. Page two, holy smokes, it's a big problem and it's only getting worse, or it's only getting bigger.
Fair enough. There's enough growth there.
Exactly. And again, keeping it binary in terms of communication, what you want to convey to the investor.
Mm-hmm.
And investors, being the way they are, you mentioned you're originating and you have deal flow as well. If it is set up in that way, most investors are either entrepreneurial or operational in the way that they think. By the time you get to your solution page, the investor would have already thought of either exactly what you're about to tell them or something close enough where they can see, oh, this person is managing this business and it makes sense. Their solution makes sense for the problem that I agree with exists, and it's a big and growing problem. So just psychologically, in terms of how you set up the presentation and the narrative there in terms of the deck, problem, market, solution.
Gotcha.
I'll cap this off by saying around the narrative, one of the most important pieces that I've seen land really, really well with entrepreneurs that are looking to raise capital is to use an anecdote. And I don't mean that in like a colloquial definition. I mean in like the actual definition of the word anecdote, which is a story that conveys a sense of connectivity to what your business does.
Mm-hmm.
Don't like if I'm an investor and you're a founder, don't just sit there and read me stats or read off note cards. Have a conversation with me. Tell me whatever you are doing, especially, people listening to this podcast are health tech or healthcare related. Tell me an anecdote of the problem, because chances are I have felt that pain point before, either personally, through
Mm-hmm.
a loved one, through an extended family, through a friend of a friend, through whatever the case may be.
You mean like a short story?
I do. I mean, like a short story.
Huh.
Now, again, short story. I'm talking about like a
Yeah.
3 to 4 sentence story that
Exactly. Not
get
like
out. Not, yeah,
full
you're
like
not sitting there for
yeah
minutes at a time.
novel.
Right, exactly. With illustrations and all that. No, you're telling an anecdote of, again, hypothetical is always difficult, but like I had clients who wanted us to raise capital.
Mm-hmm.
We would give them the strategy. They did not have the bandwidth, and weeks later would come back to us and say, Jeff, do this for us. So we productized raising capital.
Gotcha.
Right? Like I just got that out in 20 seconds. It's probably, I mean, I'm not pitching for raising capital or anything else, but massage that a little bit. You should be able to get your anecdote out in 30 seconds, in 45 seconds.
Mm-hmm.
And
Mm-hmm.
if you find yourself going more deep or too much longer than that, then you're probably starting to lose your audience.
Gotcha. Yeah. Keep it short because like beyond that, like people are gonna lose their attention. Yeah. I think like on average, I'm happy to hear your thoughts. Like I can't focus on a pitch if it's like my max is 20 minutes.
Sure, sure. And it's not surprising. One of the biggest, now another point, I don't know if this
And
is
this
for
is coming from someone
audience.
who can focus a lot. Like I've been studying for 16 plus years. I'm studying human body, how to treat cancer, machine learning, and finance. So like my max attention is 20 minutes.
I listen, you're an entrepreneur, first of all. So that's also a piece of it. And I'm the same way. And
Yeah.
that's why I tell all of our clients, or I'll tell anyone who's listening on the podcast,
Hmm.
keep an eye on time. If you find yourself talking for more than 2 minutes in a row, 2:30 in a row, whatever the case
Hmm.
may be, stop. Literally stop, like finish your sentence, and then create an interactive conversation. Stop and say, does that make sense? Do you have any questions? is this going in the right direction? Am I on the right path? Like any one of those breaking points that you can stop, you can ask the investor or your audience a question, and they have the chance to respond. A,
Yeah.
that allows you to start navigating the rest of the conversation. And
Hmm.
B, you're having a conversation. You're not just talking at someone.
Yeah, exactly. I completely agree, my friend. Okay, one last question and then I will let you go. So, looking at the trends right now, for a health tech entrepreneur, like where do you see them are going for to get their capital from? Is it like still venture capital, or do you see like family offices or other sources of money are still like valid way to raise money? Like, what are the trends?
Trends. Well,
For angel investors. Like
on one,
if I'm raising money,
yes.
where is the most successful place to go and raise money from?
So I guess three thoughts on that. Number one,
Tell
I
me.
don't think anyone should discriminate when they're building a company. Green is green. It
Green,
could go
yeah,
through electronically or otherwise, but
fair enough.
you know, didn't take this with a grain of salt, please. But on one hand, it almost doesn't matter where the money comes from.
Yeah,
I mean,
but
again,
also with
from
different
various
sources
sources or
come
whatever,
different
but yeah,
responsibility. That's
of
that's
course.
my yeah,
Of course.
like a VC versus angel investor versus like a family office versus family and friends. So that's always my fear.
And this is, it's interesting. This is actually goes back to something you said earlier in our conversation, which is the level of risk an individual investor is willing to take on.
Yeah,
And and you said it a little bit more broadly, and I want to zoom in on a piece, but you're very right in what you said. Every single investor, every single person, quite frankly,
yeah.
can be an investor, whether it's through Robinhood or crowdfunding or allocation to hedge funds or whatever the case may be.
Mm-hmm.
And every single person who's an investor who has ever invested money and not just been a pure consumer has a list of risks that they're willing to take on. Now, most investors are going to look at, New York stock market, treasuries, bonds, derivatives, whatever the case may be, as some of the lower or least risky investments that they can make.
Mm-hmm.
That has to do with liquidity, transparency, financial auditing, reporting, all these different other people investing in them, right?
Mm-hmm.
All those things reduce risk.
Yeah,
The reality is that every investor has a list of, let's say, 100 risks
yeah.
that they start day one with. A lot of them will cross many of those risks out and then leave themselves with like three or four risks that they're willing to take. And that
Mm-hmm.
represents the stock market. Other investors maybe leave three or four of them more open. And that's maybe like private equity or more institutional type of like funding and pre-IPOs and everything else. And then this is basically what you said, all the way down to startups. Now, within startups, you can have the same type of list of risks or scale of gray in terms of what investment risk looks like. If you have pre-product, pre-seed, idea on a napkin versus I'm raising my Series A, I have some revenue, I have some customers, I just need more money for marketing.
Yeah.
When I put it that way, now all of a sudden the Series A seems a lot less risky than the pre-seed company. When you zoom out, they're all part of this startup venture space of
I
investment.
completely agree with you, but one of them at least has a source of income.
True. So what that's meant to say is that it depends on the stage of company.
Mm-hmm.
What is incredibly important nowadays is forward progress.
Yeah.
Because 10 years ago, a seed investor was by definition seeding a company.
Mm-hmm.
Nowadays, every seed investor is looking for revenue.
Yeah.
And regardless of my personal disagreement with that, it is the fact. You can argue with them, and I have, but it's their money and they control where it goes. So you can argue with them until you're blue in the face and it won't really matter.
Yeah.
So the earlier you are as a company, the first round that most entrepreneurs raise, it's called the three F's:
Mm-hmm.
friends, family, and fools, because those are the only three people
Yeah,
that are
exactly.
investing in your company.
Which make holidays and vacations very weird and uncomfortable.
Exactly.
Yeah.
Or rather, and
Yeah.
I would say to that is that generally speaking, I'm incredibly excited about everything that is happening right now. And I understand
Yeah.
that there's a lot of turmoil between tariffs, economy, presidency, everything else. But the reality is, every time we've gone through this type of cycle of both innovation and economy,
Mm-hmm.
we've had an explosion of entrepreneurial
Spirit and
ventures
people
that
and
are starting.
ideas. Yeah.
Right. I mean, 2000, 2001, right? You have internet bubble. Then you fast forward 2008-ish, plus or minus, you have Facebook, social media, Twitter, all of those start to come out, plus or minus. Fast forward again, 2015-ish, plus or minus, you have not only crypto and blockchain that is starting to make waves in ICOs, which was kind of boom and bust, but still made an impact. as well as you had things like marketplaces, like Uber starting to come out.
Yeah, yeah, yeah.
Right now, you fast forward again, 2020, COVID, you had blockchain make its debut, so to speak, into commercialization, and
Hmm.
remote work really taking hold because of COVID,
Yeah.
right? And you had many different businesses spin up, create unicorns, and by nature of unicorns, many other companies that have become really successful.
Hmm.
Now we're at a point where similar type of situation, but now we have AI. And I have, I think, pros and cons or plus deltas on the usage of AI. But I think what is has been made abundantly clear that that going from zero to product, even paying customer, has been cut by exponential amounts.
It's been so fast. It's like that,
It
and that's
really
one of the
has.
reasons, literally, that's one of the reasons I'm learning like programming and software engineering on top of like everything I learned over the last 16 years, because it's like it's so easy to build software right now. It's so cool. Like right now with these AI models, like there is nothing you cannot analyze or understand. Like,
Yes.
and they are pretty damn accurate. Like most of the time. My research about using these tools in cancer decision making, they are not there yet when it comes to treating patients with cancer, but like they are good.
But it's moving, Ruben, but it's
It's
moving
moving
super
fast.
fast.
It's
I
moving
mean,
fast. We're gonna get there in the next couple of years. That's my
yeah,
prediction.
and you know what? I'll put it this way that 6 months ago, 8 months ago, we were talking about building something internally at the firm, something that we needed, we wanted, building it internally at the firm. I had it scoped out by engineers between like lo-fi, hi-fi, wireframing, drafting, MVP product, all in. It was going to take 6 months and 250K. And we were talking about a team, and that's kind of AI was 6 months ago, 9 months ago. AI was around, and we're thinking, okay, can we just build it? Like GPT will help us write the code and then implement it and all this stuff. And like it wasn't really possible then. And what I told my team was at the time, I recognized that let's build something that will not be possible to be built for another 6 months. And most of the people looked at me like I was crazy. But his whole idea of like, Gretzky saying skate to where the puck is going, not where it is. Because by the time you get to where it's going, you will be there. If you
Yeah,
skate where it is, then by the time you get there, it's not there anymore.
yeah.
Fast forward, 6, 9 months later, we built, call it 85% of the product I'm talking about for like a few $100 and I don't know, 40, 50, 60 hours of time
Oh wow. Yeah, that's
and
mind
and
blowing.
and within 2 or 3 weeks. So I think, and this is not from a technical talent. This is not from people who are spending full time on it, myself included. So to know that even I was able to do something like that, and I have very light, very, very, very light engineering exposure. The people who do sit and spend a significant amount of time on it are really able to create products from their imagination now within weeks.
Yeah,
So
and
I
that's the
so
fun
so the
part of it.
point, the reason I brought all that up to come back to your question and to kind of cap that off is to say that how should you build your product and raise your first round of funding? It
Hmm.
is easier now than it ever has been before and cheaper now than it ever has been before to get your product further and faster, meaning MVP, meaning product, meaning even a manual situation that you have to toggle just to show a demo is possible now by not getting investment in. And I understand that there are people listening that have phase 2 clinical trials that need $30 million. For now, I don't know how AI helps there. I'm sure it can and it does, and I just
Yeah,
know the application to that. So take what I'm saying with a grain of salt. But if it's an idea on a napkin, or if it's just simply I need money to do something to get to the next stage, look into the tools that are available for you there. It's probably time better spent than trying to go raise a few $100,000 to get to that point anyway.
yeah. That no, that makes sense. I completely agree with that. Completely agree. All right. I don't want to take much more of your time by the end of the day. This is the end of the day.
Sure.
So thank you so much for being here and sharing all these ideas and tips. Thank you so much, Jeff. Appreciate it. Of
Absolutely, Ruben. Thank you for having me.
course.